So welcome everyone to today's panel on bringing trillions on chain from an asset manager perspective. For this discussion, we have leaders of four of the largest global asset managers, Fidelity, Franklin Templeton, WisdomTree, and State Street. Cumulatively, just to give a sense of order of magnitude, these asset managers represent over 12 trillion in assets under management. And maybe before we start, I'll ask each of you quickly in 30 to 60 seconds, briefly introduce yourselves and what your firms are doing in digital assets.
Okay. Good morning, everybody. My name is Cynthia Bessette, and I am in charge of the digital asset management division at Fidelity. As Matthieu said, Fidelity is one of the largest asset managers in the world, and it only made a tremendous amount of sense that we stood up a unit within asset management to focus on this new ecosystem of digital assets, both native assets, for which we are bringing exposures to customers across our retail and our institutional platform through traditional vehicles. And now what we're really excited about through tokenization and on-chain vault structures is the ability to bring new exposures to on-chain investors composed of digital assets, both tokenized and natively digital assets. And all of this is driven by our research-driven culture of composing financial solutions for our customers.
Great. Hi, I'm Sandy Kaul. I head up innovation at Franklin Templeton. And innovation is broad because this digital asset universe is now expanding into every part of our business, right? So we are thinking about the interface of where digital assets touches our investment management, where it touches our product development, where it touches our marketing, the way that we engage with new audiences and new distribution venues. And so we are looking at this holistically and thinking about how it plays into some existing industry trends around personalization and customization of portfolios. And obviously wallets offer tremendous potential in that regard. So all of those different functions report up to us. Our digital asset unit is part of our innovation team. And like Cynthia, we are exploring a whole variety of new offerings and excited to be here.
Thank you, everyone. I'm Will Peck. I'm head of digital assets at WisdomTree. WisdomTree is a $160 billion asset manager, so that's our part of the 12 trillion. We are one of the kind of original ETF pioneers. I see some people in the audience who helped kind of make that happen at WisdomTree in the ETF industry more broadly. We saw tokenization kind of similarly to how we saw ETFs 20 years ago. Compared to mutual funds being the next evolution in the wrapper, the next evolution in asset management as a technology. So for us, we've got to focus around tokenized registered funds here in the United States, including our money market fund. We make those available to US retail through an app we have called WisdomTree Prime, also to global businesses through a platform called WisdomTree Connect. And I don't know, just very excited and bullish on the space.
Thank you. I'm Kim Hochfeld. I run our digital asset initiative at State Street Investment Management. I'm going to repeat a lot of the comments that everybody here on the panel's already said, but perhaps my own personal journey into digital kind of sums up State Street's journey, which is I was hired to run our cash business at State Street Investment Management. We have $500 billion worth of cash assets out of a $5+ trillion total. And we really saw what tokenized money funds could do for our cash franchise. And that's really been the journey, my personal journey, as well as State Street's journey into digital assets, which has obviously then expanded into tokenization as a wrapper, the whole theme of innovation. I'm going to have to correct you, Will, and say we invented that ETF wrapper back in 1993 with
That's not a correction.
And you know, it's part of our DNA in terms of innovating and thinking about product wrappers.
Excellent. We'll come back to the ETF analogy a bit later. But maybe before we kick off, 2025 was a big year for tokenization digital assets. I think each of your firms have either significantly scaled your tokenized money market funds or announced launches of products. If we take a bit of that step back and think through a bit of the lessons learned, we've gone from about $3 billion in tokenized money market funds, I think a year ago when we were at the summit, about $10 billion today. What are some lessons learned from an institutional standpoint, asset manager standpoint, to think through the next wave of tokenized assets?
I'd start with the objective of bringing assets on chain, and I think we heard a little bit of this from the Ondo team earlier this morning, is not just to tokenize an asset for the sake of tokenizing it. The idea of bringing an asset and representing it on chain with a token is the easiest part of the entire process. The hardest part is really building the ecosystem for utility for the asset. And when we have talked to our investors, and even when we talk to our product teams, when we talk about tokenization, we have to compare it with what is the opportunity set that investors today have in going to our brokerage platform and being able to buy every fund that is available in the entire United States, every stock and every bond. You get access through the brokerage account. What you don't get is the utility of the 24/7 access, the global access, the ability to now deposit collateral and be able to manage your balance sheet on a 24/7 basis. Because, by the way, markets are global. Markets do not close at 4 p.m. Monday through Friday, the way that our stock markets and bond markets close sooner than 4 p.m. Monday through Friday. So I think that's really what is exciting, is unlocking these new utilities and bringing the infrastructure to be able to bring investors these new opportunities.
Yeah, I completely agree with everything Cynthia said. I think they're doing great work in exploring this space. And like Franklin Templeton, we realize that there's no one model yet, right? That there are multiple ways in which you have to think about approaching this space and creating product. So you need to be open to thinking about taking today's products and figuring out how to make them available online that look very similar to today's products. You need to think about new access vehicles that allow exposure to today's products, but allow it in a way that is permissionless so that you can get those assets being used as collateral in new models in DeFi and in new lending models. Collateral models. And then you need to also think about, what does the next generation of products look like, right? Where do we move furthest away from where the existing paradigm sits in terms of how you build an investment fund, how you implement an investment mandate, how you manage the securities or the assets coming in and out of the fund, right? There's new evolution happening in each aspect of what it actually means to trade a fund based on these technologies. And you need to be experimenting with all three pathways simultaneously, because we don't know what's going to really get traction in the long run. So it's kind of an exciting space, because you really are being challenged to constantly be thinking about not only how have we done this traditionally and can it be a new wrapper, but how do we do this in all new ways that really leverage this technology to create a better financial system?
Yeah, on my end, I guess what I'd say is that unlike, when we sat up here maybe a year ago, there's been much more kind of actually organic client-like demand happening in the space over the past year. I think you can point to the Genius Act for a lot of that. I mean, stablecoins have grown from $200 billion a year ago to $300 billion in supply today. Maybe you'd like them to keep increasing faster, and we'll see what kind of drives that next wave of growth as more and more businesses are actually implementing things post the Genius Act passing. So from my perspective, it's like you've got clients, and they're kind of, the balance between them telling you what they want and also you kind of forecasting based on what you understand about your clients, what they're going to want in the future. So I do think that kind of client-driven demand is happening much more now than it was a year ago. And we always try to listen to our clients and hear what's important to them and build products for that helps them in their business.
I'm going to pick up on this comment on client demand, because we're not yet seeing a rush to the doors, shall we say, a huge amount of curiosity and interest. And if I could sum up our journey in this space, and what we've learned is the value of education. As Cynthia says, the tech now is, I don't want to say standard, but the tech is the easy bit. It's understanding how it plugs into the broader infrastructure. And it's hugely complex. Sandy, as you said, we have to try different things and figure out what works. And I think this journey for us has very much been around education, both internally, and to our clients, and also to our regulators. So much of this is, we've got to experiment, we've got to try and see what works, we'll see what sticks, we can see where the value is. But perhaps our clients can't see that, or perhaps our regulators can't see that, or our legal and compliance colleagues can't see that. So it's very much been a journey of discovery for us, hugely exciting. I suspect there are going to be lots of twists and turns in the road, but I think keeping an eye on the clear end goal, which is replumbing our infrastructure and then seeing what this new architecture can do in terms of flow and new assets is hugely exciting.
So there seems a bit of utility, adaptability, I think experimentation. And I want to spend a bit more time on client demand. I think that we had an initial dialogue there. And it still happens in many forums where I go. I get the question, which is usually quite a leading question. I don't have demand. I don't have clients tapping at my door and asking for a tokenized product, which is usually a polite way of saying, why are we tokenizing? Like, why should I care? When we think of ETF, which I think is a very interesting analogy, we'd love to hear from you, but I doubt you had clients coming knocking at the door and saying, oh, can we create this product? Yet we know the demand that has happened since. So how do you think about innovation and balancing that with client demand? Where and when do you start seeing client demand? And I think, Will, you touched on early signs, so maybe we can start with you, of where there is existing demand.
Yeah, so on the ETF point, so I wasn't there for the development of ETFs 20 years ago, but people that I work with, certainly my boss was. And no one at the time was like saying like, oh, I want an ETF, right? Like it wasn't like they were knocking on the door saying, my mutual fund's not really working that well for me. Like, can you give me an ETF? Frankly, the spider just sat there for a long time after State Street acquired it from the American Stock Exchange and didn't really do much, right? And it just kind of took, maybe a decade before more and more people launched new products. People kind of figured out, wow, there's actually really something to like the entry to liquidity, also the standardization. A lot of people talk about the tax point, but I think the standardization point might be the biggest with ETFs, saying, hey, all I need is a brokerage account, and with no new paperwork, I can access any liquid asset class anywhere in the world. That's like a very powerful concept that I think people take for granted today that was just not necessarily true when the days when you had to kind of have direct mutual fund wholesaler relationships and things like that on different platforms. So we do see that kind of potential, like you see a similar trend here. And in terms of client demand that we're seeing, I mean, one is like stablecoin issuers themselves, right? You're seeing a lot more kind of growth of new stablecoin issuers in the space, white label firms and others, not just Circle and Tether, who are looking for reserve assets for stablecoins in kind of different formats. So that's certainly one. Extending on that, you're seeing a lot more stablecoin native businesses, so people who are doing treasury operations and stablecoins who are looking for yield-bearing or other diversifying assets above and beyond what they can get with stablecoins, which can't pay yield, and then maybe pay yield through rewards, and it's kind of unclear, and like, why not just buy a tokenized money market fund, right? So that's a second example that we're seeing. And then also there's a lot of people who are in DeFi who are looking for remain on-chain, be able to use their existing infrastructure, participate in DeFi, who are looking for other yield-bearing and diversifying assets. So that's the types of clients that we're seeing. It's not somebody who's sitting in their Fidelity or E-Trade brokerage account saying, well, I've got a S&P 500 ETF. Why don't I buy an S&P 500 token? Like, that's just not the customer journey that's going to happen in this space. The ETF works extremely, extremely well for somebody who's well served by a brokerage account. I don't think they care too much about trading at 2 in the morning. So I think it's really about serving different use cases and different customers that you're otherwise not able to access. So I know I just gave a really long answer, but that was kind of...
Kim, do you want to bounce back?
I'm going to come back to the cash use case because I think that's where the use case for us is so clear. And I always like to relate the story of the mini budget crisis in the UK in September 2022, where you saw a huge dash for cash after an unfunded budget was announced. And what you saw was a huge pressure, a systemic pressure where the price of gilts was falling through the floor. And all of the LDI managers in the UK suddenly had to liquidate a ton of cash to post as collateral. Most of that cash was sitting in sterling-denominated money funds. What then happened? The money fund managers had to liquidate the gilts in their portfolio, selling them into a distressed market, causing more price dislocation, and the Bank of England eventually had to step in and stop the spiral. Now, if you'd had tokenized money fund units that could have been posted and received as collateral without forcing the money manager to sell the underlying securities in their portfolio, from a systemic perspective, you've got the regulators that are happy. From a market perspective, you've got the market that's not dislocated. And then from a money manager perspective, you've got a portfolio that keeps going. And from a user perspective, both the collateral pledger and receiver are receiving their collateral quickly, straight away. Those smart contracts would be programmed to move the collateral. So here is your perfect use case. And this is not a small use case. So the whole DeFi world obviously is a world that's expanding enormously. But the world of traditional collateral is a multi-trillion-dollar opportunity where money funds are not yet widely used as collateral for all sorts of reasons. But put a tokenized wrapper around them, and here's your perfect use case. So I don't think it's any accident that that's where we're seeing huge growth in this market. We have a perfect use case. We have a solution that suits money fund managers, collateral pledgers and receivers, regulators, central banks. I mean, it's such a perfect positive storm. So that's where this whole thing, in my opinion, is going to take shape.
Excellent. Or go ahead, Sandy. I think
So I think those were both excellent examples. We really are seeing, I think, two newer things that are starting to happen. I think that last year was kind of the year of stablecoins, and I think there was a lot of interest in stablecoins, a lot of growth in stablecoins. But I think it's evolving beyond that now. We're calling it this universal liquidity layer. And this universal liquidity layer is much more interoperable. It's getting to a lot of what Kim just spoke about in terms of collateral. It's getting towards more optimized use of cash. It's getting towards multiple options and pathways as on and off ramps. It's getting towards a growing set of yield-bearing products, right? And it's really becoming this liquidity layer that is enabling everything to start to move on chain, because the cash and the payment rails are there to now make it easy to buy other assets on chain. Like, we almost needed this evolutionary step to get this layer working where the financial system itself can start to optimize access, payment, utilization of assets on chain, the things that Cynthia was talking about earlier. So I think there's a lot of demand in this universal liquidity layer to really begin to plug these rails in. A lot of the announcements that Ian and the Ondo team were making earlier around what they're trying to enable with prime brokerage, what they're trying to enable with perps, that's all, I think, illustrative of this universal liquidity layer. And now, because that is really advancing very quickly, we're now able to start to be launching the products on top of it that are moving the assets out of these fragmented accounts that everything sits in today into the wallet. And then getting those assets into the wallet is where new demand is emerging, new demand from people who have wallets and want to directly access assets, new demand from people who have tremendous crypto profits, whatever's left after the last few days, but tremendous crypto profits that they're looking to get diversified, right? We're going to start to see now the product layer that sits on top of this universal liquidity layer expand a lot. And there are multiple demand sources emerging for that. So it's a very exciting time. What's interesting is most of the demand sources are still digitally native demand sources. And therefore, it's flying under the radar, I think, of a lot of the traditional financial industry. You really have to be aware of how the infrastructure is developing to understand where the pockets of demand are coming from right now. But as things move on chain, that's going to become better and better understood.
So it looks like demand, we're seeing use cases that are emerging, increasing products on top of this universal liquidity layer. As we think a bit ahead of 2026, what would you like to see happen this year? What's feasible in your mind? So that next year at the summit, I can ask you the same question looking back.
Maybe what I would add on from the asset manager's lens, and this is the corollary to all of the points that Sandy just made, is when I look across the innovation that's happened in the asset management industry over the last several decades, asset management is really about being able to deliver professional investment, portfolio construction, professional asset investment management to investors in a packaged product. So we started with the mutual fund, which was a tremendous innovation in 1940 in the ability to be able to aggregate a number of different clients' assets and to deliver professional investment management through that one vehicle. One trade, you get access to professional investment management. Next, I would say, comes the ETF wrapper, which gives you more real-time ability to trade that asset. I'd say, as I remember the days when iShares was part of Barclays, and iShares had a massive retail campaign. But what was the early introduction to the ETF was country baskets. It came out of the investment banking cash desks, where they were looking for ways to help institutional investors hedge exposures in more sophisticated ways than just single assets. So from an asset manager standpoint, that evolution of being able to package that into a daily intraday traded vehicle advanced, better investment and trading, and of course tax efficiency. Then came managed accounts, which was another massive innovation in terms of the technology that it takes to be able to say, I can now manage hundreds of thousands, in fact millions of individual managed accounts, personalized somewhat based on the technology across many, many investors across the platform. So providing more individualized ability to deliver that professional investment. That next innovation that this now digital asset market, and now with liquidity rails facilitating the growth of this market, is going to now allow us to provide an on-chain vault structure. That's the next wrapper. We talk about the tokens. The vault is effectively a non-custodial wrapper that allows you to be able to deliver investment management at more hyper-personalized scale. And I know, Sandy, you love to talk about, right, the range, the widely expanded range of assets now that can be incorporated into these vault structures through digital assets. And so nobody's going to ask us for a vault of tokens. They're going to ask us for more personalized financial solutions to help people manage their financial lives. And I think this next innovation for us as asset managers is not just the product, but it's the client interface. How is it that we're going to allow investors to access this new broader range of products?
100%. And I think that, when you say what would we'd like to see happen, I really think that this is going to be the year that we start to push beyond thinking about what has existed in the past as a product and how do I get it on chain, right? I think that this is the year that we're going to start to lose the differential between public and private product and be able to blend them in ways that have never been possible before. And I think that this is going to be the year that we start to move beyond US dollar into a far more diversified set of underlying products that are available in different underlying fiat currencies to really broaden out participation in the ecosystem, right? One of the great potentials of this technology is to bring countries that have had difficult time getting equal share of global capital dollars into their existing initiatives. I think this is the year that we really start to see very interesting models emerging that are bringing more countries into this ecosystem and getting capital to flow more fluidly across more of the globe.
I'll cover kind of a different topic. I mean, I think what's really interesting for me to see this year would be more stuff around digital identity and reliance in this space. And I don't mean like a kind of a government-led, like you have a digital identity now forever. I mean more like the ability to selectively share your information or have different financial institutions talk to each other in a more native way using some of what we see on chain as a way to kind of get to the promise of like no walled gardens in this space. Right now, if you're signing up with a new centralized crypto exchange, you're providing all your new information, then you want to go to Fidelity or WisdomTree, you're providing all your information there too. And like, it'd be good to get beyond that in a way such that people aren't trapped within kind of the walled garden of their ecosystem. And this applies across both crypto, at least for centralized products, as well as traditional products. And I think this technology allows you to do much more than that. And I don't think it's going to get solved this year. We've been talking about it for like 10 years now, so I don't think it's going to get solved in 2026. But it'd be interesting to me to see like real steps there this year, and I think that would be a very consumer-friendly thing to do.
Well, I have to admit that on my Christmas wish list for 2025 was the global regulators to get together and coordinate their approach to digital assets. So I think for us, that's a major challenge in really scaling what we're all trying to build here. So especially sitting in London, where we have the European Union on one side, the FCA that's trying to decide where they fit in between both sides of the Atlantic, what's happening here, really interesting how quickly some of the regulators in the Middle East have moved. It's so much easier to launch new products there, and what's happening in Asia. So I think for us, regulatory harmonization to some degree and getting some standard setting would be absolutely critical for 2026. So I hope when we're sitting here this time next year, we've had some of those loose ends tied up and start seeing the scale.
Excellent. So hopefully a lot of innovation on the product identity, and then regulation, I'm sure all of us are very focused on. Maybe in the last couple of minutes, would like to project ourselves even further. Imagine we're in a world, we have trillions on chain. What does asset management look like from a product standpoint, experience standpoint? That we started touching on personalization, but would love to get your view, like your vision. How can this transform the asset management experience?
Happy to start. I would say from the standpoint of the way that asset managers function and operate, our core competencies remain the same: research, portfolio construction, risk management. How it is that we are able to express these competencies in creating portfolios and being able to deliver those exposures is what then is that next generation of Wall Street 2.0, is the ability now to hyper-personalize and deliver down to the individual investor, not just what your long-term, short, medium, and long-term financial goals are, but how to actually hyper-personalize that to the standpoint of personal liquidity management. You can now really tie your day-to-day objectives to the way in which your entire portfolio is constructed and how you can access that portfolio, and it's all through the ease of one app.
Yeah, I would say that, there's going to be no differential between banking, wealth management, asset management, personal investing. Each person's totality of their wealth is going to be represented in these wallets, and the advice layer that's going to be able to be brought into that and around that, the degree of personalization, as Cynthia says, that's going to be applicable to that, and the ability for every one of us to bring every asset we own into the portfolio and have it considered as part of our personal exposures, that's going to be commonplace. You're not even going to notice this. This is going to be handled by agents, by smart contracts. This is going to just be your portfolio, and the way that it enables your life is going to be happening moment to moment in your life, and you're not even going to notice it because it's going to be so seamless and smooth.
Yeah, I think there's going to continue to be a lot of change in asset management. The role of an asset manager has changed probably a lot over the past 30 years, dating back to when Jack Bogle started Vanguard to today. Things have changed a lot. So I think that's going to continue to change. I think the role of curation is going to continue to be very important in a world where everything is going to be available. Kind of retail access to financial markets is much greater than it's ever been. So I think there still is going to be a really important role for curation advice in that world.
Yeah, I'll take the institutional angle for a minute, because that's our core client base. And institutions have always had the luxury of having customized portfolios. So I think what you'll see is that level of customization with much greater efficiency and lower costs. And then that will be brought not just to an institutional investor, but to each one of us.
Excellent. Well, on that note, I think we're right on time, so thank you to all our panelists.